better Roth now or forever hold your peace. The rules are changing. Hi, it's Paul Mauro. Let's talk about doing a Roth IRA conversion. And the reason that everyone's talking about Roth IRA conversions is because the projections by the Congressional Budget Office about the future of what taxes will be are pretty grim. And it starts probably 3 years from now. So let's look at this. What is a Roth IRA conversion? If you have an IRA today and you've been saving money and putting it away and saving money on your current taxes, you know that when you take money out later in life, you're going to pay whatever tax they charge you. Those are the rules. You signed a piece of paper that said, I won't pay today. I'll pay whatever the heck the taxes are in the future. Now, my crystal ball is not that good, but I will tell you, in looking at the information from the Congressional Budget Office and everybody else, it seems like that income taxes are only going to go one way in the future to pay off some of the things that we're doing today. You know, this is not political, it's just economic, it's just the facts. So, especially because we're going to be borrowing a bunch more money to fund our current activities and our current tax changes, so somebody's going to pay, and will probably be 3 to 4 years from now. It looks like that's when these things are going to hit. So let's talk about what's in effect today and also some of the reasons to do it today. And if you stay to the end of this, by the way, you can download our list of 6 reasons why you should do Roth conversions now, 2025, rather than wait. I mean, one of the reasons is if you have an IRA and it's growing, right, and you do a Roth conversion, if you do it now, highly likely it's going to be smaller than doing it later. Perfect example. If you're going to convert a $500,000 Roth today, it's going to be cheaper in taxes than converting a $600,000 Roth later. Okay, forget the tax rate. What we want to do is we want to convert the seed and let it grow to a tree. We don't want to convert the big tree. Okay, so convert the Roth IRA before it gets too large. That's one of the reasons, right? Second thing is this unknown tax rate gets a lot of people really wound up. Income taxes are highly, highly flexible. As many of you know, I ran a financial practice for like 50 years before I started doing this educational stuff. 47 tax changes in 50 years explains the whole thing. There will probably be 47 more in the next 50 years. I don't know. But one thing for sure, if you look at the projection of where taxes need to go to pay off certain obligations that we have, especially to our debtors like China and Japan, you're going to see that we will need to raise tax collections in the future. So how are they going to do that? They may take away the right to do Roth conversions. They may force everybody into paying taxes long term on the distributions, you know, the required minimum distributions. Reasons that people do Roth today is they lock the tax today, they pay it once and forever, and there are no required minimum distributions in 2035, 2045 at some unknown tax rate in the future. So it's locking today's tax rate and eliminating uncertainty. That's a big reason why people are doing it. The second thing is it's very easy actually to pay the tax. In 2025, there's about 4 different ways that people pay the income tax on the Roth IRA conversion. It means you take your $500,000 IRA, you do a conversion. Next year, April 15th, that money's going to show up in your tax return. You're going to pay some taxes on it. Now, I have no idea what your personal tax bracket is. You need to meet with and take the advice of your personal financial advisor, your CPA, whatever, on what that tax bill is going to be. Once it's done forever. You never pay taxes on growth again. You never pay taxes on income that you take out. Depending on your age, after even just 1 year, your principal is available to you tax-free. After 5 years, generally all your earnings are available to you tax-free. And if you're over 59 or 60, you don't even have to worry about the 5 years anymore. I would say that if you're a 60-year-old especially, the sweet spot for Roth conversion might be that first year that you have low retirement income, right? Because you're going to be adding some ordinary income to your tax return. But even so, even if you are still working and you look at your tax return and you add on the money from the Roth conversion, you might still make an estimate that you're in a better situation today than adding it on in the future at a higher potential tax rate. So taxes are a big part of this. The second thing about it is the devices to pay off the income tax bill are very diverse. There's quite a few ways. So let me just say that we have seen these 3 or 4 techniques used to pay the tax bill on your IRA Roth conversion. Number 1, if you have, let's say, a $100,000 tax bill, it's very easy nowadays to get a margin loan against your mutual funds, ETFs, and stocks. So let's say you have a $200,000 portfolio over at Schwab, Interactive Brokers, or Robinhood, whatever. They all have very low, it's kind of like a passbook loan against your portfolio. You get $100,000 tax-free loan against your portfolio, you pay off the tax on your Roth conversion. Now, what's cool about that is if you have a portfolio, and let's just use Interactive Brokers as an example. If you have a $200,000 portfolio, it's all full of McDonald's stock and Philip Morris, and it's got like a 4% dividend, and they charge you 6% for that loan, it's offset by the taxes on the 4% portfolio. So here's what it means. The interest cost is deductible against the earnings on the portfolio. So that 4% dividend that you've been paying taxes on the Philip Morris and the McDonald's stock is deducted, so that really that 6% loan is just only 2%. Okay, so it's a very inexpensive way to pay a tax bill off. So those are called loans against your portfolio. They're called portfolio loans, margin loans. They got a lot of different names for it. But when you go online, look at your brokerage. By the way, if they don't have good, attractive margin loan programs, then you can switch brokerages. I don't work for any of these people, but I will tell you that we do like Interactive Brokers, and we do think, Fidelity has a program. We don't think it's the cheapest one, but it's a decent one. Schwab has one. So do a little shopping on how to borrow against your portfolio to pay off the loan. Of course, if you have cash in the bank, you can do that too. If you have an excess of cash, and that seems to be the condition of a lot of our retirees, if you have an excess in cash, you can just basically write a check and pay the bill. It does help you reduce your estate if you're trying to get your estate down for tax purposes. But sometimes people in retirement don't want to use up their money that's in the sort of savings bank or in a CD, and they want to either use a temporary either equity line or reverse mortgage to pay it. So I just had someone 70 years old, very similar circumstances. They did a $500,000 Roth conversion. They had a tax bill. Their CPA calculated was like 30-something%, 150 grand, once and for all. And they wanted to pay that so that their children did not have to pay the income tax in the IRA. Remember, one of the big reasons to do Roth conversion is it's pay me now or pay me later. Either you pay or your children pay. Now, her son is a very successful young man in New York City, and he has about a 55% tax bracket between federal, state, and city tax. And if you took that $500,000 and he inherited it and added onto his income, he was going to pay a lot more than grandma's tax rate at 35%. So we had a bill to pay, like 140-something thousand. All right, we went through all of the different ways to do it, and she has some cash in the bank. But you know what? She also had this little home she's been living in for years, and she had a lot of equity in the home. And so she just used the $130,000 as an equity loan against her house. She actually used the reverse mortgage clause because she didn't even want to have the mortgage payment, and nobody wanted her little ranch house anyway. So she used equity in her home to pay the tax bill. So what she did was a triple play. She made the taxes cheaper for her grandson that was going to inherit the money. She basically used tax-free money to pay a tax bill. And she liberated her entire IRA for her own use going forward. So I think it's a really great triple play technique. And again, using a reverse mortgage, she didn't have a payment. Reverse mortgage interest just accumulates against the house, and at mortality, when the house is sold, is paid off. But you could also use an equity line. We've had clients use equity lines just to basically not cash out investments and pay the tax. Now, the third thing is that when you're doing a Roth conversion, I think it's like really important to meet with and take the advice of all your advisors. Here's the biggest tragedy in life, and this really applies to those people that are 75 and over. If you're a 75-year-old person, your portfolio allocation should have been considerably ramped down in terms of risk. That means that instead of being 80% in equities, if you're 75, you're maybe 25% in equities, right? And the rest is in fixed income and cash and safe things. So converting a portion of your investment portfolio, that's your Roth, from being in equities to adding more fixed income to your portfolio can really work. We talk about fixed income. That also includes things like the guaranteed annuity contracts that are out there. So anything that has a guaranteed principal and guaranteed interest that's not tied to equity markets, we call that fixed income. If you're rebalancing your portfolio, and this especially applies to a 75-year-old, if you're rebalancing to get safer and more insulated from market fluctuations, and you're going to be doing that anyway, this is an unbelievably good time to look at the reallocation of your IRA to a Roth IRA in a fixed income product that is not subject to market fluctuations. And I'll tell you why. Here's the worst thing that can happen is you pay $500,000 of IRA, Roth conversion, pay all the taxes, and the market turns your $500,000 IRA into $400,000 you paid twice. You don't want to pay taxes on one lump sum of money, then put that into the market and lose a portion of it. That would be bad planning. So if you're going to do a Roth conversion, if you're over 70 years old, and especially if you're at 75, I think it's a very good idea to make whatever you've paid taxes on completely 100% guaranteed. And right now, as an incentive in June 2025, you're able to do a Roth conversion, satisfy all things that we're talking about. Lock the tax down today, convert it to something that's guaranteed, get that off the books for your children. And also, you can receive as much as 2% to 21% bonus on doing the conversion. What does that mean? Well, if you hear the commercials from Robinhood and all the other brokerages, transfer your money to us and we'll pay you 2%. Transfer your money to us, we'll pay you 5%. This is very common technique used in Roth conversions because the money you get paid in bonus money is a tax-free addition to your Roth. So imagine you convert your $500,000 Roth and that $500,000 Roth all of a sudden becomes $550,000 with that extra 10% being tax-free. The bonuses are up to as much as 21%. They all have rules and regulations and restrictions. And you can reach out, leave us comments, share this with anybody that you know that's in their 70s thinking about doing Roth conversion, because it appears as if all the rules for Roth conversion of IRAs looks like they're up for a change in the future. And also, it's highly likely that if you don't do it now, you could end up paying more money in the future in taxes or lose out on the potential transfer bonuses available in June 2025. So doing an IRA conversion to a Roth account for the benefit of your own tax savings and the benefit of your family, that's just part of the art of being smart.